page.
All right, everybody. So welcome to those of you who are online and in person. So there's pretty much only one housekeeping item, and that is that we've got this sound bar up here that literally will pick up every sound in the room. And so when the speaker's talking, we want to have them be the only one talking. Otherwise, it gets really jumbled for everyone who's online. Thank you all for coming. Thank you, Edie, for coming from FEMA Region 9. We're so happy you made it over the mountain. And thank you for Erin Warnock, who is here from the state. So I will go ahead. Well, let me just let you know, Shane and I will be monitoring the Zoom. So if you have questions, we will be looking there. I think the agenda included the schedule, so you kind of know when the Q&A is. And I think that's about it. And so without any further ado, I'll just introduce Erin Warnock, our state floodplain manager.
All right, thank you, Debbie, and thank you everybody for being here today and being online. I'm just going to give a little introduction of the Nevada Floodplain Management Program and just a little bit about some insurance, and Edie will then take it away to kind of the changes we're going to be seeing within the NFIP in Nevada. So this is our staff over at Division of Water Resources, Nevada Flood Program team. Myself, I'm the state floodplain manager and NFIP coordinator. Sarah Fickner is our mapping coordinator, and Carlos Brendo is our public outreach manager. Kayla Meyer is our flood program specialist. She is a contractor though, so we just get to see her from time to time when we've got enough money on our grant. And then our mission at the Nevada Floodplain Program is to create flood resilient communities in Nevada that encourage the protection of life, property, water quality, environmental values, and the preservation of natural floodplain functions. So we have 35 participating communities in Nevada, and all these stats here are kind of pre-risk rating 2.0. So you can kind of take a look, and we're going to go over how this is going to change a bit for us moving forward. But this was the stats is where they stand kind of moving forward into risk rating 2.0. And CRS, this is overlying the CRS in Region 9, but we have some good statistics down there at the bottom for Nevada. Just our total policies in force are 10,205, and then we have 4,247 in the CRS communities, and we see about an average of 70% of savings when we're in CRS communities. And today I was on Watershed University that California was hosting, and they're talking a little bit more about, there's a conversation being started about how CRS can kind of work in conjunction with risk rating 2.0 moving forward to kind of allow these better rates for the people of Nevada. So you might just want to keep that in the back of your mind if you are a CRS community, maybe trying to improve your rating or considering joining the CRS. It might be something beneficial for your community that we'll see moving forward with risk rating 2.0. And disaster declarations, I just like to remind people, we saw that in 2017 and 1997. So floods, you know, they do happen in Nevada, and it's important that we're prepared and we're letting our communities know how to be prepared and giving them up-to-date insurance information. These are the pillars of our office. This is kind of our duties and what we seek to serve as the state. So we support our local floodplain managers through trainings and workshops. So this is kind of a public outreach event that CWSD really took the lead on, and we're grateful to be co-hosting this. But this is kind of an example of what a training or workshop might look like, somewhere like this. And we would go over facts about the NFIP, elevation certificates, anything our local floodplain managers need to know or might need help with. And then we provide mapping coordination and support. So we're always a part of kind of the mapping that's going on in Nevada. We don't actually do the mapping, but we're always there to support. And then we also help with the local hazard mitigation plans and the state hazard mitigation plan. We just came up on our 5-year cycle to renew that. So I went through and I reviewed the floodplain section for the state hazard mitigation plan and brought that all up to date. And I'm always providing technical assistance. This is a huge part of my job. So please reach out to me anytime you guys have questions as local floodplain managers or as staff working in floodplain management. If I don't get back to you, email me again, because I get a lot of technical assistance requests, but that is my job. And then community assistance visits. You may have heard of that. That is where we go out to our communities that participate in the NFIP and just assist them to make sure that everything is in compliance with their ordinance and what they've agreed upon to be part of the NFIP. And then just an update, while I have a lot of you local floodplain managers listening in, we're doing something a little bit different moving forward with CABs. So we're going to be doing a lot more CACs. So a CAB is a community assistance visit. A CAC is a community assistance contact. So we're going to be reaching out to more communities more often. We're trying to get everybody on a 5-year cycle. So some of you on the call might be going through one of those CACs with me right now, where I request a certain amount of documentation, you fill out a questionnaire, and then we just kind of touch base about your flood program and your community. And that is kind of where we're moving with that. And then based on the visits or the contracts that we have, visits will be established afterwards based on the need. And I would just like to recognize all of our partners that make floodplain management possible in Nevada. So this is just only some of them, and a lot of them you can see are pretty local to the Carson River watershed. So they do a great job here. Thanks again so much for helping us host this CWSD. And now I would like to welcome Edie Lohman. She's an insurance specialist from FEMA Region 9. And we are so lucky to have her here today because she is probably the most knowledgeable person at Region 9.
But my name is Edie Lohman, and I am the National Flood Insurance Program Insurance Specialist in FEMA Region 9. And I am thrilled to be here, absolutely thrilled, because this really is the best way for me to learn anything new that's going on with the program. And I love having a lot of new faces in here and online, and a lot of familiar faces. And the familiar faces, I'm just going to say, don't beat me up too badly because we're all learning this together. So thanks for having me. This is a new way of rating for the National Flood Insurance Program, and it's called Risk Rating 2.0. And I know some of you have heard a little about Risk Rating 2.0. Some of you probably, this is brand new. How many people have not heard about risk rating at all, or you don't get involved in insurance of any kind? Okay, so everyone gets involved in insurance. That's good. That's music to my ears. But what we're going to do this afternoon is we're going to, let's see, how do I advance this? I should be able to. No, I'm sure it's the operator that's not.
I might have broken it.
Give me one
All
sec.
right.
I'll bring it right back to you.
Okay, yeah, no problem. But this is a brand new rating system that we're implementing, and you know, honestly, it is one of the biggest. Thank you. It always helps to have the tech people here, because if there's anyone that can mess it up, it would be me, for sure. You should see me trying to do this online. That's even more fun. And my kids say, I don't understand. It's so much easier to do it online. What is the problem exactly? But anyway, so today we're gonna do a high-level overview of risk rating, and I am going to enjoy the discussion and the questions that you guys have. I do not have all the answers. FEMA does not have all the answers. And this is, like I said, brand new. So if your head feels like it might be spinning off the top of your body, you're not alone. Mine is still spinning off the top of my body, actually. I've been working with the National Flood Insurance Program for a long time. And this is really quite different from the way that we've operated in the past. And it is going to change a lot of things, and it does change a lot of things. But at the same time, it's exciting and it's new, and we needed to do it in the program. So the point here is don't get frustrated, because risk rating, as far as I know, is here to stay. And so we will all have plenty of opportunity to walk away from sessions feeling, wow, like I really would like to hear that again, or I am so confused now. And so this is kind of what the way this goes. So don't get frustrated. I'm going to go slow. If you have questions, feel free to join in and let us know what your comments and questions are. I usually carry a pad of paper with me, which I have with me today. And the reason for that is because I like to collect all of the questions and the comments that people have. And then I submit them to FEMA headquarters. They have a team of people who are collectively working on answers to the questions and reviewing the material so that we can use it to better future outreach and communication materials, and to work on things that might need to be tweaked from the program. So they developed this at headquarters. We're rolling it out in the field, but guess what? We're the people that actually get to use it and work with it. So they're now listening to us and asking for the feedback. What works, what doesn't work, what do you like, what do you love, what do you absolutely hate, what should we fix, what don't you understand, what doesn't make sense. And so I'm collecting all of those and sending them in. And I'll tell you, I did a presentation last week for the Floodplain Managers Association Sacramento chapter. And we had a long list of questions. And I submitted those last night, and they had a team literally of 10 people emailing me this morning with, can you explain this? And what about that? So they're on it. They're on it. I was very impressed. And these were the people who were involved in developing it. So, so for today, I broke the agenda down basically into 3 parts. I want to do a little bit of an overview without losing people, and then talk about, well, what are we going to do with all these existing policies that were rated so differently? How do we just turn this off and turn it on? That's an interesting question. And then a little bit about the premium impacts and what the actuaries have estimated based on best available information, keeping in mind that this is new and we really won't know if these estimates are close to actual until this time next year, when we have like a year under our belt and we can actually see if this bears out. Okay, so let's do a little bit of an overview with risk rating. And as many of you know, and others may not know, the new risk rating 2.0 system rolled out officially October 1st of 2021. So as of October 1st of 2021, all our new NFIP policies were automatically rated under risk rating 2.0. There was no turning back for any of the new business, and there is no turning back. There are some statutory caps that apply, like we had in the old system, because those statutory caps are legislative. They're built into the Bigger Waters legislation from 2012 and the HFIA, the Homeowner Flood Insurance Affordability Act of 2014. So they are available. And I'm talking about pre-firm subsidized primary residences. I'm talking about newly mapped properties and SRLs, and there's a few minor categories that are built into the legislation, okay? But everyone else that isn't part of that statutory discount group is, if they're new NFIP business, they'll be rated under the new rating system as of October 1st. So at the beginning of this month, April 1st of 2022, as people's policies renewed. So if they had an existing policy, as their policy renewed on or after October 1st of 2022, we will be rolling them over automatically to the new rating system. There's nothing that the agent has to do. And this is just built in. So the servicers, the third-party servicing companies who service the Write Your Own companies that write the NFIP policies, they all have interfaces that they have built that go directly to FEMA's new risk rating engine. FEMA owns the risk rating engine. It's managed in DC, but each of the servicers in the Write Your Own have an interface that goes to that. Now, the interfaces can differ from servicer to servicer, depending on what their needs were. But as policies come up for renewal, existing policies, that's the point, on or after April 1st. What will happen is the agent will run a risk rating quote, a risk rating 2.0 quote, to see if it's cheaper for them. If it is cheaper than what they're currently paying, we just convert them right over to risk rating 2.0. And if it's not cheaper, then those people will be on a glide path. And I have a chart that's pretty simple and straightforward, and it's mainly because I have a very simple mind. So I needed a cheat sheet, and I decided to build it into the presentation because it helps me, and hopefully it will help you. But so one thing that's not going to happen is for people whose policies come up for renewal April 1st, we're not going to see them go from $500 or $600 and jump up to $5,000 or $6,000 like we did for bigger orders in 2012. For those of you that were around for those unintended consequences, that was not good. So that's not happening. So I want to put that out there up front, because I think at the end of the day, people want to know, how does this, how much is this going to cost me? Number one. And number two, how does this impact how I build my house, or how I can do a BCA, a benefit cost analysis on a project that I'm working on for my community, right? So we have part of that answer. We don't have all of those answers just yet. So we're working on it. Now, I could spend hours talking about this slide. However, I know most of you have probably seen it before, number one. And number two, I'm be preaching to the choir. So the bottom line here is we know that water doesn't read flood maps. Okay, so the water, when it comes to town, does not stop at the AE zone in the lower left corner of this slide. And so what's happened is a couple of things. This person in the yellow house, let's say they're in an X zone. The water is going to come right through, most likely, the AE zone, and also flood the house, the yellow house that you see that's outside the special flood hazard area. But guess what? The person in the AE zone is paying maybe $3,000, $2,000, depending on the age of their building and how it's constructed. But the person in the yellow house probably has a preferred risk policy, which is a policy we offered under the old system, which was significantly discounted to encourage people in X zones to purchase flood insurance. However, that policy would have been about $500. Now, you go to a public meeting, I'm not an engineer, and you try to explain to somebody why, number one, Edie Lohman's house, which is in the AE zone, gets to pay $2,000 or $3,000, gets flooded, same amount of coverage we're carrying. The guy in the yellow house, though, is only paying $500 or $600, and he has the same 2 inches of water in his house. In my simple mind, you're going to really have a hard time convincing me that, you know, what's up with that? So we have these rate cliffs, and we know that risk is really graduated. It's not binary. It's not that you're in a flood area or you're out of a flood area, right? And we are historically, over the last 5 years or more, we have seen the risk increase significantly in X zones. So outside of special flood hazard areas, lots and lots and lots and lots of people are getting flooded. And we have a lot of that in Region 9 because we're in the arid states, and a lot of it is pluvial and inland flooding, local flooding, just occurred flooding, maybe even a one-off kind of thing, but it's happening a lot more. So there's a greater frequency and severity of the damages is getting greater. So risk rating 2.0 is there to address this graduated risk and this increased risk that we're seeing. And from a financial standpoint, the National Flood Insurance Program has been in $20.5 billion of debt to the US Treasury that we can't dig ourselves out of for a series of storms. And it's just getting worse because we're paying more claims in outside the special flood hazard area, and the premium is so discounted. On a side note, because my background is private insurance market cannot compete with a federal government program that's willing to offer a $500 policy for that person who's going to get flooded. They can't touch that because they have to answer to their stakeholders. They have to make a profit. And if they don't show a profit, then they're not going to be able to write it. It's just that simple. You know, so I think I spent more time than I was supposed to on this slide. So I'll move on. I have more to say, but I'm going to move on. So under the old methodology, the old rating methodology, we really only had the flood insurance rate maps to do any geographical differentiation of risk for us. And we really only captured one elevation, right? We had the elevation for the 100-year flood in most cases, and that was it. And we looked at riverine and coastal flooding, and that was it. So it's very limited and it's inflexible, and our rating system was based on for the most part, on 3 key factors, right? The FEMA flood insurance rate maps, the age of the building, and you know, maybe what type of building it was, right? Very limited. And we didn't have a lot of different elevation data, but you know, honestly, when this program was introduced in the 70s, this is what we had. These are the studies we had. This is the data we had. This is the data we used to build the system. The old rating system, it was built in the early 1970s. It's a manual system. It was never changed. It was never updated. Some of the write-your-own companies did automate it, most of them. They had it on software. But you know, if Rob called me and said, you know, I have these, I need a rate on a building. I literally had a binder this big, and I literally sit there and ask him a series of, I don't know how many questions. And I'd go through the binder and I would hand crank out the rate, literally by hand. That's ridiculous. You know, that's really archaic, right? So we needed to get into the 21st century, right? Just because the world moves on. The technology is there. The science is there. We need to take advantage of it and we need to use it. Now, I will say that I feel like for once, the insurance side of the National Flood Insurance Program is a little bit out in front of the mapping and the mitigation and the grant spokes of the wheel. Okay, they're trying to catch up. They're like, whoa, 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 whoa. So we're a little bit out in front of them, but it's okay, right? We had to start somewhere. So while this worked for a very long time, and we're not throwing it out the window. The new rating system is incorporating the years of flood hazard data material that FEMA has in its armory. So we're not throwing it out the window, but we are not using flood zones, base flood elevations, and base flood depths for rating at all anymore. So that is a big change. Okay, now let's go to the new rating methodology, because now you're probably saying, well, if you're not going to use that, then what are you using? So the first thing, yeah, sure.
Are they going to change the name of the firm then?
You know, people are asking that. I don't know. So the question was, I don't know if you could hear him, Rob, online, but he said, are they going to change the name of the firm map? For now, probably not, because one thing that I should mention is the firms are still being used for mandatory purchase. So flood insurance rate map, right? They're still being used because it's required under the law that the lenders use the most current FEMA flood insurance rate map. So we still have to use the firms for mandatory purchase. And so that is under discussion, but that's not a FEMA call, right? But that's a great question. And lots of people are asking that question. So the new rating methodology, the first thing you're going to notice is, whoa, we have all these new inputs that we are building into this automated risk rating engine. And I do say automated because literally you answer some questions and push the button and it cranks out the premium. And that bugged me for like, I don't know, 3 years they were working on this. I kept saying, no, I don't understand. Go back. I don't understand, because I'm used to being able to open the hood of the car and look at all the parts running and be able to, you know, be like a grease monkey, right? My little mechanic, and get in there and shift levers, change levers to make adjustments to premium. Well, we can't do that anymore. So I have to hang up my little grease monkey hat, which I hate, by the way. And now we're looking at a automated, what I like to call blender. So we have this huge Vitamix, and we're using all these different sources of data, and we're doing actuarial model blending using, you know, private sector data sets, FEMA source data, other federal government source data, and then procured private tools like a replacement cost value tool, a first floor height tool, and a geolocation tool that I can't see. So it all goes in the blender in addition to the questions that the insurance agent will be asking the policyholder, and you turn the blender on and literally it spits out a premium. But I can't tell you how it does that. And I can't tell you which components, for the most part, we know some of them have a bigger impact than others if all things are constant, and we'll talk about those. But we can't see inside the blender. In fact, no one at FEMA has access to the risk rating engine. So if you called me and said, can you give me an approximate quote or something on this building if I answer all your questions? No, I cannot. The only people who have access to the risk rating engine at this point are insurance agents and the right-to-own companies.
This is past all the legal barriers of it's legal to do this without being able to justify how you're coming up with that number.
Well, you'll see, there's more to it than what I'm saying, but I bring that up because that is the first, usually that was the first thought that went through my head. Let's put it that way. data sets. Wow, okay, this is great, you know. Put them in the blender, turn the blender on, out comes the premium, right? Totally different from you calling me and saying, okay, I have this and I have this. Well, if we do this to the house, how does that change their annual premium, right? Because that's what I'm used to being able to do. So this is totally different. So we're doing, as I mentioned, we're using FEMA sourced map data. So we're using the mapping data that FEMA has developed over centuries now. They're using mapping data integration and the probabilistic flood risk analysis and the Great Lakes studies that they've developed. They're adding in additional federal government data sources, which are public data sources that anybody can look up and see. We're going to talk about each one of these. A whole bunch of new rating variables that we should have had in the calculation to begin with, because they're Insurance 101. We're going to talk about those. Replacement cost is one of those rating variables, but we're calling it out because it does have a big impact on the premium. We've not done replacement costs before, other than on the claim side. The statutorial fees and surcharges are the same for the most part. That's not changing. When we go to the left, though, you'll notice that we're calculating now many more, a broader range of flood frequencies. It's not just riverine and coastal. Now we're adding in tsunami, coastal erosion, and inland flood, the pluvial flooding, because we're seeing so much more of that. And, you know, up 10 years ago, the catastrophic modeling for flood was not available. It's just been in the last 5 years or so that the private industry has put together catastrophic models. And so the private industry catastrophic models, they're using them to price flood insurance. We are now using those same models to be consistent. And so those are going in to the blender. I'm sure I'm going to think of something else I want to tell you about that last slide when we're 5 slides ahead, but I'll figure it out. So this I've already talked about a little bit. We're not throwing the FEMA data out the window. It's going in. You know what that data is from where you're sitting, probably better than I do. But we're adding in 3 catastrophic models. So we have procured a catastrophic model from CoreLogic, Cat Risk, and AIR, which are the 3 largest flood catastrophic models out there. They ran many models, but those were the 3 that they came out with the closest average annualized losses that we know mimic the program. So that's why they use those. We purchased a geolocation tool. The geolocation tool is private LiDAR data from CoreLogic that provides 3 elevations on each building that's being rated. So it has a much broader range of being able to capture elevation, and it also will capture our flood frequencies. So what is that building subject to? When we use the firms are great, but they capture the greatest risk for the building. So if the building is at risk from 2 perils, we capture the greatest one. This will capture, let me go back. This new risk rating methodology will capture all 6 if it applies to that building. And they will weight them based on the riskiness from each one of these perils. And it's the geolocation tool that's doing that. And the geolocation tool is based on the property address, which then converts to a latitude and longitude. And then they can use geospatial data to figure out these other components we're going to talk about. First floor height tool. We have also purchased a first floor height tool. It is not perfect. The goal behind the first floor height tool, and the whole goal behind the new risk rating program actually, is to make it easier for insurance agents to quote flood insurance. Because our goal at FEMA is to make sure that people have insurance, all types of insurance, whatever type of insurance they need for where their building risk is, and the right amounts of that insurance. We don't care from flood perspective whether it's coming from private flood or the NFIP. We just want to make sure that they're aware of the risk, they have coverage for it. Because disaster assistance, as you know, is very, very limited, and it's not always available. And people think quite the contrary. And we could spend a long time talking about that, but you guys are all seasoned professionals, so you've lived it, you've breathed it, you know exactly what I'm talking about. The first floor height tool is a tool that is really establishing the difference between the lowest floor elevation and the building's lowest adjacent grade, if we want to really get down to it. We also purchased a replacement value tool. The replacement value tool will provide replacement cost value using standard private industry practices that have been used for a long time on a lot of our residential policy base, because we do not have good replacement cost value data on our residential business, which is 95% of our book of business in the NFIP. The other 5% is commercial. Those buildings, we have good replacement cost value data already on file. That's just the way it rolled out. So the additional data sources we're using also includes NOAA's coastal data set, USGS elevation, digital elevation models, and then U.S. Army Corps National Levee Database. Okay. So for the premium calculation, you can really put it in 3 buckets. So the calculation for each building is unique and individual based on the variables for each of these 3 buckets. The geographic variables, which is the building's physical location and the different ground elevations and flooding sources that are near this building location, at or near. Building variables, these are the actual building characteristics of the building. Is it wood frame? Is it masonry? How many floors does it have? Is it residential? Is it commercial? Those types of things. And we're going to go through each of these. And then other variables. The other variables are the insurance components, like, is it eligible for a statutory discount? How much coverage? What's the deductible? Those types of things. Does it have a CRS discount? Those types of things. So the next few slides, if you see a gold star next to the variable that's in any of these buckets, that means that has a heavier weight. If we have 2 buildings and everything else is the same for these 2 buildings, whatever that gold star is, if that's different for the 2 buildings, that's going to have a heavier weight. And I'll explain what that means. So for the geographic variables, we're capturing all of these things that you see on the right automatically with the geolocation tool. By putting in the property address, we're capturing distance to the flooding source or sources, right? So my brother lives in Cape Hatteras. Well, he's got a risk of flooding from the ocean and the bay, right? They're about half a mile apart, if that, where he lives. So people understand that. That has a big impact on the premium. It's understandable. The closer you are to the flooding source, the more risk you have of flooding. People can understand that. That's measurable. We do that with the geolocation tool. Local relative elevation. Is your house sitting in a bowl relative to the grade around it? Is it sitting in this little bowl, or is it sitting on a bump in the hill where when it rains, the water is going to flow away from the building versus flow towards the building? Okay, so the local relative elevation, we're trying to capture the heavy downpours of rain, basically the pluvial flooding. How much risk is this building at pluvial flooding? So we're looking at a 500-meter area around the perimeter of the building for the local relative elevation. And then we're also measuring with the geolocation tool elevation relative to flooding source. So we're looking at the building's lowest adjacent grade relative to the average surface elevation of whatever the flood risk is or the flood source is. So let's say it's a river. You know, the river, the average water surface elevation based on mean sea level is right here. The house lowest adjacent grade is up here. Or like in Hawaii, if you've been to Hawaii and you've driven along the coastline, it's lapping at your door, literally. There is no higher lowest adjacent grade. It's right there. So we're measuring that. We're taking into account the territory, or what we're calling the MSA, which is a metropolitan statistical area. And that just means how many policies do we have there times the risk? How risky is that area? That's what we call in private insurance a cat load or a concentration load, which is something that was already built into the NFIP policies. We just didn't know about it. It was built in nationally to all the rates at about 10%. Now we're going to be able to use the geolocation tool to narrow in and focus on a specific metropolitan area to see what that looks like and assign a factor. Yes, ma'am.
So we have a situation where we have a community that's in a county and we've been lumped in with a city that's in a different county than us. And I don't know if it would be better for us to stand on our own. It's only because there's no post office, so they use the post office zip code. So we're lumped in with things, and there's two different policies of how the counties deal with all this.
That's an interesting question. And I'm not sure I know the answer to that. I think they would be doing it by zip code more than county boundaries and jurisdictional area, but I can find out for you.
And these aren't contiguous at all. I mean they're contiguous to it, but there's
Yeah.
ground in between. So
Yeah.
it's just that it was too small to have its own post office.
Right.
So
Right,
right, arbitrarily was picked
Yeah.
to go here.
yeah, that's a good
So-
question. Yeah, that's a good question. I need to check on that one. Yeah, good question. That's a good comment. We're going to look at the drainage area and the HUC 12 and the river class. You know, how big is the flooding source? How many tributaries does it have? So the geographic variables are really capturing a lot more geography on the building surrounding area, unique to that building that we weren't able to capture before. And that's a good thing. The data is out there, it's available. This is customary and standard in private industry practice. So we're now implementing it. The challenge is these are not values that the policyholder is able to see, or that ED Loman can see on their declarations page. They aren't listed. And so that has made some of us nervous. Oh, what about this? What about that? So there is the option of the policyholder completing an elevation certificate and the agent using the elevation certificate. We're trying to automate, and in that process, we're trying to do away with elevation certificates. But they always have the option of submitting one, and they don't have to get a surveyor or a engineer to fill out the elevation certificate for risk rating 2.0. They can fill out section E on the current elevation certificate. There will be a new elevation certificate coming out. It's out there for comment right now in the Federal Register. That has a whole entirely new section, section H, dedicated strictly to policyholders who would like to fill that out themselves and submit it to their agent so they can double check some of these. And we did that intentionally. So we have a backup plan. Headquarters is running audits and checks just to make sure that the tools that go into the geographic variables are working as we had hoped. So far, so good. We have seen a few differences, but those mainly have to do with levies, and that data is coming out of the National Levy Database. So they are working closely with the Corps on fine-tuning some of that up. Building variables. These are visible to the policyholder, so they can actually go over these with their insurance agent or actually see them on their declarations page. Construction type. We're capturing, is it frame or is it masonry? We know from our claims history that masonry buildings hold up better. We don't pay as many claims on masonry as we do frame. We do realize there are many, many different types of construction of buildings. But again, one of the goals of risk rating is to try and simplify so that we can all understand and we don't have to memorize a manual that's this big, right? So, and really construction type, we're looking at, if it's a mixed construction, we're really looking at the first floor, because that's where the flood water is going to hit first, and it's going to have the greatest impact. Number of floors. How many floors does the house have? Floors above ground. So that doesn't include basements, crawl spaces, or enclosures, right? We want to know how many floors, how many living floors, finished living floors does the house have? So it's not including garages either. Foundation type. We had in our agent flood insurance manual, I think something like 70 diagrams of foundations. Can you imagine? 70? Really? We have 6 now under risk rating. So E.D. Loman can recite them on my hands, because we only have 6. Slab on grade. We have slab on grade. We have crawl space, whether it's subgrade or above grade. We have basement, and we have elevated with no enclosure on post pile pier. We have elevated with enclosure on post pile pier, and we have elevated with solid foundation walls. How simple is that? I love it. It's my favorite thing. That and no elevation certificates. Love that. Okay.
Edie,
Yes,
what about the whole notion of flood vents?
we're getting to that.
Okay.
Hang on.
All right.
Hang on, that's the next slide. First floor height. This is different than lowest floor elevation. We're not using lowest floor elevation for rating, for risk rating. And you're probably going, what? Why? That's going to mess things up. Well, it's definitely muddying the waters between the CFRs for floodplain management and what we're using for insurance. But for insurance, it's automated. And the reason we're using first floor height instead of lowest floor elevation, as we've done in the past, is because first floor height is standard in private insurance industry. It's language, we want to speak the language of the private insurance market. And this is automated. So we purchased a tool to determine first floor height. If we were going to use an elevation certificate to determine first floor height, we would do that by saying lowest floor elevation minus the lowest adjacent grade, because that's really what it is when you get right down to it. So we have a tool for that. And then we have the elevation certificate for backup. But elevation is still going to matter. The higher they're elevated, especially if it's on piers, piles, posts, the greater it's going to have an impact on their premium, all things considered. Replacement cost value, we have a tool that's going to capture that. No worries about it. It's going to be captured. It is a big component of the overall premium. Okay, mitigation credits. Let's talk about mitigation credits, because we're broadening mitigation credits. There are 3 mitigation credits at this point in time. Okay. They are, actually there's 4, sorry. There's construction on post piles and piers. There's flood venting. There's elevation of machinery and equipment. And there's flood proofing. So I will tell you that these mitigation credits, when I say they've been broadened, what I mean is the credits, everybody's going to start out with a base rate. And if you do one of these, if you have one of these mitigation credits on your building, then we will discount your premium from there. Okay. Now, everybody, every building in every flood zone is now eligible for any of these 4 mitigation options. Except, remember that we have restrictions on flood proofing for residential buildings, right? So that's something that's regulatory, and we don't have basically any regs that say we can flood proof residential buildings west of the Mississippi. So Region 9 is kind of out of that game. But the flood proofing requirements, the CFR requirements, they're not changing. They're staying the same. Post pile pier construction, it's staying the same. It's just that if you are built on post piles and piers, it's going to have the greatest impact if you're within 500 meters of the coast, right? Obviously. Coast meaning if you have a risk of flooding from any coast. So not just a house on the beach, but one that maybe is inland a couple miles, but there are estuaries or channels or rivers that are flowing to your house from the ocean, and that gives you that coastal flood risk. Okay. Flood openings. The flood opening or the flood venting requirement is not changing. We're not changing that from the floodplain management standpoint. It's a 5% credit, and it's a self-certified credit that policyholders get. Sorry, back up. That's not true. That's for machinery and equipment. Flood venting is on a scale from 3 to 27%. Okay, so it's based on the type of foundation, so that the percentage of the discount they get for flood openings is based on the type of foundation that they have, the size of their enclosure, and where is their finished floor. So those 3 things is what we're looking at for flood openings. It is a self-certifying credit. So the agent's going to ask them, do you have flood openings or not? And of course, everyone's going to say yes. So I arm wrestled a little bit with headquarters on some of these. And I said, you do know that everybody in the world, when you ask them if they have flood vents, they tell you yes, because they see vents. And those are air vents, not flood vents. And when I'm talking to them on the phone, I can Google their house and I can zoom in and see them eating breakfast now. So I know what kind of vents these are. So you're telling me they're going to self-certify. How is this happening? Exactly. So we saw a live quote about 2.5 weeks ago from National Flood Services, which is one of the big vendors. And I was jaw dropping because I thought I better either get another job or retire in the next year. It's so intuitive. A trained monkey could not screw it up. And so when we got to this, I specifically asked, you know, can you show this to us? Well, it was just, I don't know how they did it, but they made it very intuitive. You can't mess this up. I mean, unless you're just drunk or you're not paying attention, you know? So that's the good news. Same thing with elevation of machinery and equipment. They have diagrams there, they have colors, they have arrows, they have descriptors. And it's not like it's, oh, I hope there's no one else from FEMA on this call. It's not like the FEMA, it's not like the FEMA stuff that we come up with, you know, where we have it like this. And you're arm wrestling with the diagram, trying to figure out where the arrow is supposed to go. And I say that very affectionately, but not so much if you're trying to use those as tools in the field, right? But they've got it down. And so the elevation of machinery and equipment, that is a 5% discount. It's self-certifying. And it's going to be based on the foundation of the building. And because our policy forms offer coverage in enclosures and basements and crawl spaces for certain categories of buildings, we'll have to capture whether it's pre-firm, post-firm, and what flood zone. Because we're looking at elevation of machinery equipment. The one thing about the elevation of machinery equipment is it's all or nothing. So it's either all elevated to the next higher floor, or it's nothing. You don't get the 5%. And again, we could have made it more complicated, but they were trying to keep it simple, right? So the machinery and equipment has to be elevated above, at or above the finished floor. No, it has to be elevated above the finished floor. Let me correct myself. So think about this. Oh,
Another question.
you're going to say it, I think. Go ahead.
Okay, do they have a list of what these utilities are?
Oh, yes. Thank you. Air conditioner, furnace, hot water heater, heat pump, elevator, and yes, there's 6, and I'm missing one. Heater, air conditioning, huh?
Pressure tank, if you have a well. Pressure tank.
Pressure tank, is that, are you asking or saying?
I'm suggesting that might be.
Oh, maybe. I'll check what the 6th one is, but it escapes me for some reason.
Is that like natural gas meter or something?
The pressure meter,
No.
is that what you're at? No. So it's really simple, but I just forgot. Heating, air conditioning, heat pump, hot water heater, elevator and equipment. I'll look it up for you. But here's a challenge. So my house is slab on grade. So my air conditioner is sitting out on a pad on the side of my house. My hot water heater is in the garage. You step down 2 steps in the garage, and then it's elevated in the garage. Furnace is in the attic, but on a slab on grade building, that would mean, according to our new rules, that all my machinery and equipment that I just named, the hot water heater, the furnace, and the air conditioner, they have to be in the attic, because my finished floor it's the slab that I live on and walk on, right? So the rules say it has to be elevated above that. So I said, Wait a minute, I have a question. My house, you're telling me that I need to put the air conditioner and a hot water heater in my attic. I said, you do know that Sacramento is 120 degrees in the summer, right, in August? And you're suggesting that I can't get my 5% credit because I can't put that up there. And they were like, yes, that's exactly what we're saying. And I said, well, I think you're gonna get a little pushback from that, from, you know, West Coast in particular, because we have a lot of slab on grade and that's how a lot of things are built. They're looking at it. Phase 2 to come.
So when you're talking about the above the floor,
Yeah,
so for existing buildings, I mean, this is not new, but if your base flood elevation, you're supposed to have your floor higher than that. And then
Yep.
there's rules for some communities have it 1 foot over, 2 foot
Right.
over, whatever.
freeboard, yeah.
So are you counting, is it just based on wherever your floor is and it's above whatever your floor is, no matter what your situation is? Or does it have to be higher than whatever the rules are, the BFE?
So we're not changing the floodplain management regulations. So machinery and equipment still has to be wherever you say machinery and equipment has to be for floodplain management to satisfy the CFRs and whatever other additional requirements you have. But for the insurance side of the program, we're now saying all the machinery and equipment has to be, those 6 things have to be above the finished floor. And that works fine. So if you have a basement building, the floor would be that first floor that they're living on, right? So it's different. We're divorcing floodplain management regulations with the insurance regulations. I guess that's the point. So don't try to like
So your
overlap.
insurance isn't gonna care if you're not conforming or not.
Yeah, exactly. So this is one of those disconnects that we are working on, right? Because, you know, in this program, in the National Flood Insurance Program, the insurance has always supported and still is supposed to support the mitigation and grant side. If you do this, then we give you this. This is a good driver reward, right? So we're trying to make those connections. So stay tuned. This is still a work in progress. So I have an example for you. I texted my brother for Easter and I said, you know, happy Easter. And so, oops. And so he texted me back his NFIP declarations page. Nothing else, just his declarations page. And I'm like, okay. So I tried to snapshot it onto this slide, but I couldn't get it on there. So I just made my own table. And there's a lot going on in this slide, but I'll sort of explain it to you. So just as an example of how this is working, good or bad, right? I was a little taken aback by his premium. So he's in a flood zone X. He lives on the beach. So I will tell you the way this works. He's in Cape Hatteras. I don't know if anyone's been to Cape Hatteras, but it's a barrier island where the ocean's on one side, the bay's on the other. And so let's pretend this front desk here is the sand dune. So in North Carolina where he lives, the sand dunes are, I mean, you can't see the ocean over the sand dunes. They're huge, right? For good reason. So he lives in back of the sand dunes. So the people who live closer to the sand dunes, which is, there is a few houses that live closer to the sand dunes. They're in VE flood zones, as in Victor Edward, VE coastal. Okay, that's great. He's the next row back. He is in this band of X zones. It's just like this really weird thing when you look on the FEMA flood insurance rate maps. And then behind him, across the road, is the bay, but there's a whole bunch of homes there. And so those people are all in AE flood zones. All this to say that he's always had a preferred risk policy, right? I can never understand why, but he's not ever been flooded. He has had flood water on his property. He moves his cars to higher ground when the waters come in because the cars would be flooded. So it's enough water, right? So here we are last summer with my neighbor. My brother looks like Dave Letterman with the beard now. Anyway, so the red arrow is the dune. So he's pretty close. You walk over that dune and that's the ocean. It's a pretty big beach, pretty wide, but still. So he's got $250,000 of coverage on his building. The contents coverage, I don't know, we have to have a chat about that. He's got 38,000. I don't know why he doesn't have 100,000, but whatever. Single family, as you can see, it's elevated post-pile piers. His first floor height is 3.9 now. 13.9. He's up, what did I say?
3.9.
No, 13.9. Sorry, thank you. Big difference. So the first floor height is huge here, even though he's close to the coast. Frame construction, house was built in '86, flood zone X on FEMA's flood insurance rate map. But look at his premium. So when people get their declarations page, this is actually what they're going to see, just so you know, under risk rating 2.0. They give you your building premium at the top, your contents premium, then we load in the increased cost of compliance premium, which is now 1.9% of your building premium. It's not on a scale that like it was before, but it turns out that it's about the same amount of money as we were charging before for the ICC premium, give or take $1 or $2. Mitigation discount, his is $9. All his equipment's elevated. He's got a community rating system discount. But what people will see is their full risk premium. So one of the requirements under the Flood Insurance Reform Act of 2004 and Biggert Waters and the Homeowner Flood Insurance Affordability Act of 2014 was for FEMA to communicate everybody's full risk premium to them. We could not do that because we did not have the data on most of our policy base. If they had an elevation certificate, we could use the old system to calculate a full risk premium for them, but not using the latest and greatest data and actuarial science like we are now. So his full risk premium is $329. And then if you go down, we add in the reserve fund assessment, the HFIA surcharge. This is a primary residence, so it's only $25. Federal policy fee is now $47 instead of $50. Few bucks break there. No probation surcharge. His total annual premium is $460.
Good deal.
What a deal. That's what I told him. That's a deal. That is a real deal. But to me, the fact that he's elevated so high, I think the BFE for this area, and I actually should have put it on here, but I did not put it on here. But I think it's, I don't remember what it is, so I won't even go there. But he was like elevated over 7 feet higher than the BFE. Let's put it that way. And his rate was determined based on an elevation certificate because where he lives, the community requires elevation certificates on all the buildings. So he did not use the first floor height tool. His agent did not, because he may have ran it, but if he did run it, he got the better discount with the elevation certificate, which is something to remember. because obviously elevation certificate, it's a ground survey. It's gonna be more accurate than any tool, pretty much, right? Because it just increases the accuracy. So that is the reason why we have that elevation certificate option still there for people who either already have them or they want to fill out section E on the existing elevation certificate, or they want to fill out section H on the new one when it comes out. That's Lucy the dog. She likes to be photographed. And that's me trying to desperately hang on to her because she sees a cat. Okay. The other variables are pretty intuitive. I won't spend a lot of time on them because they haven't changed from what they were before. These are also values that the policyholder will see and be able to adjust with their insurance agent if they want to. Their coverage, their deductible. Is it an occupancy type? So is it a residence? Is it a commercial building? Is it a primary residence or something else, like a rental? Is it eligible for statutory discounts, newly mapped, pre-firm, primary, subsidized rate, AR zone, A99 zone? Those are the statutory discounts that I talked about earlier that are, in the federal law that we need to comply with. CRS discounts. Just a little bit about CRS discounts. That's also a big driver. But the CRS discounts have changed in that we've broadened those also. Since we're not focusing on flood zones and base flood elevations and things like that, for CRS, if it's a class 5 community, under the old system, only the structures in special flood hazard areas would get that 25% discount for class 5 community. Well, under the new rating system, everybody, regardless of their flood zone, is eligible for that 25% discount. Okay, that's different. That's way different. Now, they're not eligible for it until they reach their full risk premium. So whatever CRS discount they're getting now, if they're getting one, that's what they will continue to get until they reach their full risk premium. Once they reach their full risk premium, they will then get whatever that full CRS discount is. So it's a class 5 community, then they would get the 25%. And it also works backwards for communities that get retrograded. Okay. We are looking at prior NFIP claims for the first time. So this works very similar to when you make a homeowner's claim. You sort of have to make a decision, right? Do you really want to submit that claim because it could impact next year's premium? When you get into an auto accident, ding, 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 that counts against you. And when you get your premium the following year, you're probably going to see that's reflected in your next year's premium. So the way the prior claims will work is we're going to look at a 20-year rolling period. And we're using 20 years because that's the data set that we have that's most reliable. That's the time period, going back 20 years. Nothing counts until you start being rated under risk rating 2.0. And nothing counts until you have your first claim under being rated under risk rating 2.0. And then we're not going to look at, we're going to zero that out. So you have one claim under risk rating 2.0, we're going to zero that out, but we're going to look back 20 years and see what other claims you have. And so that is what's going to impact your premium. Okay.
A question about that.
Yeah.
Is it very property specific? It's not the general area that you're in, how many claims there are?
It's
just
property specific. So we're looking at how many claims have been on that building, regardless of ownership. So I'm glad you brought that up because it triggered in my mind to tell you that it goes with the property, right? when people get their declarations page, we will tell them how many claims they have on that building. And we will also let them know that by filing a claim, it could potentially impact their premium. Okay, we don't have a lot of data on how big the impact's going to be. I think the actuaries will know, they know what that equation is right now, but I don't have a live example that I can give you because we just rolled out risk rating 2.0. So Brenda, did you have a question?
I do kind of, I'm not
Okay.
sure exactly how that, but, so you were saying with the community rating system, that they won't be getting that discount until they, have reached their, what was it?
Full risk premium.
Full risk premium. How long after 2.0 is out, will that take before people reach that? And how is that going to impact the communities wanting to do community rating system? Because if it's actually not going to help their community until they've reached the full, amount, I'm just wondering about that.
Yeah, so a great question. So we're not going to take anything away. So if they're getting a CRS discount now, they're an existing policy holder, they're getting let's say they're getting a 5% or 10% CRS discount, and they're going to go on a glide path because it's not cheaper for them to be under risk rating 2.0. Then they'll just stay getting that 5 or 10% CRS discount. But they're going to be on that glide path to their full risk rate. And when they get to that full risk rate, which is estimated maybe 10 years down the road plus, when they get there, then they'll get that 25% discount in the example I used instead of just the 5 or 10%. So we're not going to take anything away from anybody, but we're going to make it so that when they do get that full risk premium, it'll help offset the full risk premium by, the higher the classification that community is. So it actually does incentivize the community to have a higher rating. Let's say you're a class 1, you get a 45% discount. That's a lot of money off of an annual premium. I would love that for auto, fire, whatever, any store in the world, Amazon. So to me, that would be an incentive for communities to, work towards these higher classifications. Interestingly enough, a lot of the policies in the policy base are already full risk rated. So we have just under 5 million policies. 3.4 are residential single family homes, and about 1 million of those are PRP, and about 1 million, if I'm remembering this chart correctly, about 1 million or a little over 1 million are already full risk rated. So we're not really too far off. We're not as far off as maybe I would have thought in my head. And maybe I have the chart in here. Let's take a look. And that's a great question. So we're gonna. Oh yeah, sorry.
So just to clarify, so what you're saying is if people who already have a discount are like grandfathered in, but people enrolling into new policies now after that October 1st date won't receive a discount if they're in a CRS community until they reach that full capacity on the line.
Close. That's a great way to explain it. I might hijack that.
Okay.
But if they're coming straight away into risk rating 2.0, they don't have an existing policy, they're going right to their full risk rates. There's no glide path unless they are newly mapped, which doesn't get a CRS discount. Or they are pre-firm subsidized primary residents, or they are AR, A99, So if they are protected in that statutory discount category, and that's a good comment / question, because we're going to segue now into, what does this look like for the policyholders? So let me go there. Okay, so this is existing policies, transition existing policies. The new people that come in are going right to risk rating 2.0, period, unless they're in that statutory group.
And right to the top grade.
Exactly. They're going right to their full risk rate. Okay, but let's talk about, sort of broke this up into 2 columns. So on the left, you have the existing policyholders, and then on the right side, you have new and lapsed policies. And when I say lapsed, this is super important. If they let the policy lapse for more than 30 days, they're going right to their full risk rate. There's not going to be any ifs, ands, or buts. That's a change from people under the old system. Okay, but it's just clean and simple. So we're making sure that people keep their policy continuous. All right, so I mentioned this in the beginning because people get terrified that a preferred risk policyholder, as an example, goes from a $500 or $600 policy to $5,000 under risk rating when their policy comes up for renewal since April 1st of this year. Not true. So if you have an existing policy, you're going to keep whatever rate you were paying unless your agent determines that it's cheaper for you to be under risk rating 2.0. And for some people it is. It's actually cheaper for them to go straight to their full risk rate under risk rating. They've been paying too much, so they're going directly there. But for the people where risk rating 2.0 is more than they're currently paying, they're all going to be on this glide path, and this is the glide path. So they'll get 18% increases every year till they get to their full risk rate under risk rating 2.0, with the exception of newly mapped. They just did this to trip me up, I know. Newly mapped is 15%. Okay, so pre-firm subsidized AR, A99, they're on a 5 to 15% annual glide path as determined by FEMA's underwriters, actuaries. And with the newly mapped and the pre-firm subsidized, those 2 statutory discounts that you see listed there, it's a one-time discount. So they'll get a discount of 60 or 70% off of the first $35,000 of coverage, one time. And then after that, they're just straight up 15%, 15%, 15% until they get to their full risk rate. So we discount it at the beginning for the first time for new policyholders, but then they're on that 15 or 18 or whatever their statutory discount is that's going to be applied to them. So I guess the takeaway here is new policyholders go right to their full risk rate under risk rating 2.0. That started October 1st. Existing policyholders on a glide path. And they will know what their full risk rate is as their policy renews on or after April 1st of this year. So they'll get their deck sheet, it'll say what their full risk rate is. And then just like my brother's deck sheet, it'll tell you at the bottom what you owe for the premium. But existing policyholders are going to be on this glide path, 18% unless it's pre-firm subsidized or pre-firm subsidized primary or newly mapped. But look on the right-hand side. Risk rating 2.0 eliminates the preferred risk policy. It eliminates all grandfathering, whether it's zone grandfathering or BFE grandfathering, because we had two types, right? That's gone. Everything else is okay, but those two. And the lapsed policy is a big deal. That's 30 days. So we have to remember to make sure that people's policies get renewed, especially if they're on a glide path. Because if they're on a glide path and that policy lapses, they will then go directly to full risk rate. Unless they are on one of these, well, there may be some exceptions in there, but I won't go into those right now. So you might be wondering, just for myself, I was wondering, what does this book of business look like for our Region 9 states? Well, this is what it actually breaks down to, and you can see Nevada is in the dark blue on the end. So this was as of February of 2022. We had roughly 9,788 policies here. 2605 of those were PRPs, 505 were newly mapped, 470 were grandfathered, and believe it or not, 6,208 are already full risk rated, which, so that line really surprised me. And of course, you don't have any coastal zones here until we have a big earthquake in California. And then we'll have a different conversation. So that's kind of what the policy composition looks like as of February. And the policy counts in all of our states are dropping, by the way, a lot from the last 5 years. And I can't tell you definitively that they're going to private flood, but they're going to private flood. And, you know, that's okay, as long as they have coverage, because there's more and more private flood out there being offered. The NFIP is not the only game in town now. So we don't mind that. That's fine. But we hope they do stick around when there are floods. And if people leave the NFIP and they go to private flood, we have that lapse coverage issue for some of them if they try to come back because their private insurer jacks up their premium or sends them a non-renewal notice for some reason. I'm not saying they are going to. I'm just saying these are all things that we have encountered, challenges we've encountered in the past. So, yes.
This is just kind of a theory question. Do you think that we're noticing policy drops at all on like Western United States? Because a lot of homes are being purchased outright.
Yes, I would say, yeah, I would definitely say that. Like I was telling a bunch of people beforehand, we were in Arizona. I was in Arizona 3 weeks ago. My daughter's young. She's trying to save money to buy something there because California is so expensive. And it was unbelievable. We went to a couple open houses and the realtor said, don't even think about it. We've already had like 3 cash offers above asking on this property. I just want to show you what's out there. And I'm like, well, this really isn't what's out there because we can, you know, but you're right. To your point, it's, I don't know. I want that money tree that people are using to buy these $1 million plus, huh?
It's a lot of corporations.
Yes, that's what the realtors told us, that it was a lot of corporations. And I thought that was, I'm still pondering that, actually. It is sad because it's pricing people out of the market, but
So
then,
it's 3:13. I don't know
Yeah,
how much of
we-
your presentation we have, but we do want to leave
yeah, we
time
do.
for Q&A.
Yeah, thank you. Yeah. Okay, so we talked about the lapse. Let me show you this really quickly. And this is all online, by the way.
And We can make your presentation available afterward.
No,
Oh, we can?
well, unfortunately, we don't have permission from headquarters to
Oh, okay.
release the slides. However, I do have a 2-page resource page that will sum
Okay,
all
you
of
can
this up.
send us a
Yes,
resource page.
absolutely. So that's where you will find all of this information. But nationally, the actuaries are estimating that about 23% of policyholders will see a decrease. About 66% will see, $0 to $10 a month or 100 up to 120 a year increase, which is about what they're averaging right now, and they have been averaging the last 5 years, is about $100 a year increase. And then about 11% will see something between 120 and 240 increase. So how does Nevada stack up against the national predictions? Well, not too bad. So 21% decrease versus 23%. 73% are more in the middle instead of what it was 66% nationally. We have more people in that middle range who are not going to experience any more of an increase than they've been experiencing in the last 5 years. And then we have less people, 6%, who are going to see that 120 to 240 increase as a result of risk rating somewhere in this year. So this is for the first year. This is estimated. We won't really have the charts and the data to compare this to until this time next year. But we did want to have something for people to go on. This is where we have a lot of the risk rating resources. We tried to consolidate all of the risk rating information on one website, and this is where it is. We'll send this information to you, so you don't have to worry about writing it down. There's a great video on the top of the page that you see on the slide, and then when you go to the bottom of the slide, there's a couple of things that I do want to point out, which aren't pictured here, but you can look at a really detailed methodology guidance on both levies and just the risk rating engine in general. There's also a worksheet. You can see the variables and different examples of how, if you have this, but you don't have that, or you're this far from the coast, or you're, this close to the coast or the river, how that looks as far as how that impacts a premium. And you can play with that. Also, there's an email address at the bottom of the page. Take advantage of that. Submit your questions and your comments there, because that's what we're collecting right now, because we're testing this out, right? This isn't risk rating the end. It's risk rating the beginning. We're going to have to make tweaks to this as things move along. This is phase 1 of many. So take advantage of the experts who are monitoring that email box. They will get back to you. And we're using that data to inform, as I mentioned, other outreach materials, presentations, and actually things that we may need to tweak in the actual engine going forward. So it's just great feedback. Whoops, I'm going backwards. No. FloodSmart.gov, they just stood this up about 2 weeks ago. If you go to FloodSmart.gov, and I'll send you this website as well, there are many great, there's probably 6 really good fact sheets out there that I carry them around with me because they're just great reference. Oh yeah, I forgot this little detail about risk rating. Or, somebody asks a question, well, what machinery and equipment? They're great little tools as we're all learning this process. There's a lot of details behind the scenes. You can't remember it all. So, you have to rely on the resources. So these are good things for us. They're good things for you. They're good things that you can hand out to your constituents or your property owners and anybody else who wants them. And it's, they just stood this up. They did a tremendously great job. I love it. ASFPM has also a lot of good material in their library, in their resource library. It's not especially easy to find, but if you Google, you know, if you go to the ASFPM website and then you type in their search bar risk rating library, you will get there. But I will send you this information as well. And this is the email that you will find on the bottom of the main risk rating page to submit, you know, questions and comments if you have them. And then I am always available to confuse you further. So, you know, the way that I learn is actually from your questions and your comments. And so I like to hear what's going on in all of our states and our communities. And I promise you, I will get you an answer to your question. I may not be able to answer it on the spot, but we have a lot of experts at headquarters and they are way smarter than me. So we'll get you an answer for sure. And this is how you get a hold of me. So that is all of the information I have for you. Rob, it's actually 5 pieces of machinery and equipment. Don't ask me where I got 6. I think because there's 6 foundation types, maybe I got that crossed over somehow, but I don't know. So it's the 5 pieces of equipment I mentioned. And so with that, I'll open it up for questions.